Now, slightly softer than expected June core inflation reading in the US keeps the chances of a September Federal Reserve interest rate cut alive. But the risk is that we get less benign prints for July and August. That means we will need to see clear evidence of softer jobs figures to trigger Fed action before December. So underlying US inflation rose by less than expected for a fifth month in June, and that comes even as the details signaled companies are beginning to pass some tariff-related costs more meaningfully to customers. A decline in rentals and car prices helped keep a lid on this figure. However, goods categories exposed to President Trump's tariffs, including toys and appliances, rose at the fastest pace in years. The report gives a little bit of everything to Fed policymakers who seem to be equally divided. This latest inflation report gave Trump more ammunition to attack Fed Chief Jerome Powell on interest rates. He capitalized on the tame number to step up calls on the Fed to cut rates. Trump in a social media post said, I'm quoting here, consumer prices remain low, bring down the Fed rate now. However, most economists agree that the impact of tariffs on inflation is not showing up completely yet because of the lagging nature of such pass-throughs to consumers. For now, investors still expect the central bank to leave rates unchanged once again at its meeting in 2 weeks. More importantly, the Fed does not want to get the inflation path wrong again as it did post-COVID. The Fed was stung by criticism after suggesting the post-pandemic supply shock price hikes would be transitory, only for inflation to hit a near double-digit rate in 2022. A majority of Fed members will want to ensure that tariffs are a one-off price change rather than something that leads to higher for longer inflation. The real question is, will there be enough evidence for the Fed to cut rates by September as expected by the markets?